Hi there, welcome to Kneppy Invests. A bit of an ad hoc video today, a video on the fly, just because of what happened on the overseas markets, particularly on the Nasdaq, down 5.1% overnight. Really interesting trading over the past one day and about 2 hours, ever since the Fed decided to raise interest rates by 50 basis points. We saw a really interesting reaction from the American markets. In fact, they rallied about 3% in 1 hour. It did cause me a little bit of confusion why the markets would rally like that. But when you do think about it, it does make sense because it does. When the Fed raises interest rates by 50 basis points, that is certainty. So leading up to the Fed raising interest rates, there's still a little bit of uncertainty about how high they're going to raise interest rates. It could have been 75 basis points. So even though the raising of interest rates by 50 basis points was to expectations, it decreased the amount of uncertainty in the markets. And that's why the markets did rally. However, the smart money took the opportunity to set out of some of their shares. And that's one of the reasons why the Nasdaq and the Dow Jones, S&P 500 fell by quite a bit, 5.1% for the Nasdaq on Thursday. And again, this is all to do with inflation and the possibility of interest rates rising even further in the future. And when you consider the state of the economies, and really, to be honest with you, the state of the economies is not that healthy right now. Typically, reserve banks will raise interest rates when the economy is running hot. It's not doing that now. We've got pretty high inflation. That's the only reason they're raising interest rates right now. Pretty high inflation. We're not really seeing massive wage rises right now. I think we will, particularly if inflation becomes an ongoing problem. We will see wage increases, wage rises, but there are always going to be a bit of a lag between inflation and wages keeping up with that rising cost of living, which means real wages are going down. If real wages are going down, people are going to spend less, and that's not good for the economy. Not only that, we've got rising interest rates, rising mortgages. So people will be spending more to pay their mortgages. Again, that's going to put a lid on the economy, put a lid on spending. So typically, one of the reasons why you want to raise interest rates in a high inflation environment is because of demand pressures. So increasing demand. So we really spending a lot of money. And that's not really happening now. I don't think it's really demand that's driving inflation. It's more of the supply side. So I think we are heading for interesting times, and I wouldn't be surprised if increasing inflation leading to increasing interest rates leads us into a recession. And if you do follow the bond market is already hinting at that possibility. Bond market is the market you want to listen to or read or try to understand, not really the equity markets. The bond market is forward-looking by many, many years. The equity market is really only forward-looking by 3, 6, maybe even 1 year. It's not really forward-looking by 3 or 5 years, even though you will get experts telling you you have to invest for the long term, and they're talking about 5, 10 years. Overall, the equity market is very short-sighted. So right here, right now, I do have the Nasdaq US, the NDQ, which is the top 100 companies. And it is really looking bearish right now. We did have that pretty interesting day where the market was up 3%, or the Nasdaq was up 3% after the Fed raised interest rates by 50 basis points. So I thought if that momentum could keep on going, we've just gone through this support level and resistance level a couple of times now, but with this big down day, 5% down day, we're now right at the lows we did see a few days ago. So a little bit more bearish than it would have been if we didn't see this 5% down day. But we are in a downtrend. And the other thing to take into account is when we are in a bear market, you're going to see more volatility. You're going to see these big up and down days. Now, in a bull market, you can see these big up and down days, but they are much rarer. We have seen these massive swings in the market quite often over the past, we'll say 4 to 5 months. And that is a sign of a market moving into a bear market. And the whole psychological reason behind that is when investors, particularly those buy the dip investors, see a big down day, they find the opportunity to buy on the dip. However, there's going to be other investors, particularly the smart money, who sees a rising market and see the opportunity to sell out of some of their companies at higher prices than they were a few days previously. So it's sort of a fight between those buy the dip investors and those fund managers. And in that sort of scenario, the fund managers will eventually win. So I wouldn't be surprised to see a bit more of down period in the American markets, particularly because of the concerns around the economy. So the flash crash we had because of COVID-19 wasn't concerns about the economy. It was concerns really about what the virus was going to do. And then the governments reacted, the reserve banks reacted in this sort of situation. And I don't think you're going to see significant reaction, fairly quick significant action from banks and reserve banks, because they are a little bit, I won't say scared, but they are a little bit mindful that they can't react as they did during the COVID-19 panic. So that's why a lot of times bear markets can last 1 year, 18 months. It's a very healthy correction, very healthy movement in the markets, particularly if the markets are overvalued, and particularly the Nasdaq, particularly constituents in the Nasdaq, all those tech companies have been overvalued for a long time. So it's very healthy to have this correction. So I am starting to put quite a few tech companies onto my watch list, my potential buy watch list. But when you look at some of the individual charts of these individual tech companies, really bearish. So I am waiting, remaining patient, waiting for my time to take positions in these high quality companies. So that's the Nasdaq right now. Now, the market was down, or the Nasdaq was down, I think it was 5.06%. Now, the last time it was down this much was on the 3rd of September 2020. And if we go back to that period, actually, before we do that, I just want to show you something really interesting. And that was, if you go to the 5-minute chart. So this is the 5-minute chart. And you can actually see the market reaction, which happened around about 4:30 my time, when the Fed raised interest rates. You can see the Nasdaq climbed from about, it was just under 13,000 all the way to 13,560. So a massive rise in the Nasdaq in a very short period of time, about an hour's period of time, based off the Fed raising interest rates. And then it just fell off a cliff the next day. So that's really interesting, just to see how the market has reacted to the Fed raising interest rates, not only in that 1 hour period, but also in the next day. Now, you will find a lot of commentary around why the markets, or the Nasdaq, American markets, reacted like this in the 1 hour after they announced this raising of the interest rates. Also, on the, what date was it? The 5th of May. A lot of commentary about why this is happening. The market is fearful of inflation, but this is just a sign that the market is torn. And eventually, because the market is torn, eventually I think what you'll see is potential more downside from here. It's not a guarantee, but there is that potential, simply because we are seeing some bearish signs from the American markets, particularly the Nasdaq. But if we go back to the daily, and if we go back to September 2020, and here it is. So when we had on the 3rd of September 2020, when the market was actually down 5.2% on this day, it was after a long period when the market was up. It rallied a lot from the bottoms of the COVID-19 financial panic. So it was really healthy to have this little bit of a pullback during that, not only that day, but also a few days later, 8th of September, the market was down 4.8%. So vastly different from what we're seeing now. At that point in time, September 2020, the market was in an uptrend. So a nice little pullback, a definite buy the dip opportunity right then. Very different to what we're seeing now. Now, the last time before the 3rd of September, we saw the market drop 5.2% was during the COVID-19 financial panic, where we did see the market actually drop 12.2% on the 16th of March. So again, this correction in the market during the COVID-19 period was a flash crash. It only lasted 1 month. Typical bear markets last much longer than that. I don't consider this a bear market at all. It was just a flash crash, a very short-term flash crash caused by something, or black swan event, something that no one saw coming. Right now, there's a lot of possibilities in the future in regards to the economies in the world, and I think the market is getting nervous about that. So vastly different scenario when you talk about the flash crash in March 2020 to what we're seeing now. Now, if we go back even further, I want to take you all the way back to 2000, because this is really interesting. Now, and I've already talked about when you do see bear markets, there is going to be a lot of volatility, because there are participants in the market who think the market always goes up. It's not entirely true. And so let's go back to 2000. And the Nasdaq reached a high of 4,800 in March of 2000. And at that point in time, I was in upstate New York studying for my meteorological degree. And then we did see a little bit of a bounce down period. And this, during, say, March into April, was the end of the uptrend in the Nasdaq. You can see the uptrend in the Nasdaq really began probably about 5 or 6 years period, and it ran from about 400 all the way to 4,800. So it 12 bagged in about 6 years, or even less than that, 5 years. So it needed to correct. It would have been healthy to, and particularly when you see the Nasdaq actually accelerate, or the rise in the Nasdaq actually accelerated during the later period of 1999 into the start of 2000. It actually rallied from about 2,400 to 4,800. So it almost doubled. So you're always going to see a really healthy correction after that. But how low or how long can the correction go for? Now, it's really interesting. The first bit of correction in the Nasdaq in 2000 drove the Nasdaq down from 4,800 to 3,000, and that was a support level. We can see a nice little bounce of 3,000, so that's right in there. In fact, if I draw a line at that nice little correction, that was the support level. We've got a double click there. That was the support level, and if the Nasdaq fell below 3,000, that would have been a bullish or bearish move. So we actually had to wait, or the Nasdaq had to wait about 5 months before the market actually did fall below that level. And that was confirmation of a new downtrend in the Nasdaq. That happened towards November, or in November of 2020, when it fell below that 3,000 level. And it just kept on dropping. And if we draw 3,000 from that low, in fact, I'm going to go to the weekly chart here, because it took a while for the Nasdaq to reach back to 3,000. It took until 2013 for the Nasdaq get back to that now resistance level. And then it broke through it and kept on going. So it took 13 years for the Nasdaq to get back to those levels we saw back in 2000. So even though you always get told the markets always rise, now it is true over decades and decades, it will eventually rise. But sometimes if you buy at the wrong time, you can be waiting many, many years before the market gets back to that level. So that's all I really want to talk about with the Nasdaq. Now let's have a look at the XAO and the XJO. So not as bearish as the Nasdaq and yes, the American markets. So right now, the All Ordinaries is down 2.1%. So I'm recording this at 11 a.m. on the 6th of May, 1 hour after the markets have opened. The XAO has just coming off, almost reaching all-time high. But again, just like anything, all charts, you can put in a nice little resistance level. And there is a really good resistance level just there. And the reason I'm calling that a resistance level is it's reached around about 7,900, just below 7,900, 3 times in the past. We'll call it, well, what's that? July of 2021. This is the weekly chart. So if you go to the daily chart and just zoom out, you can just see that level being reached. In fact, you can just draw it a little bit higher. That level being reached 3 times, so a triple top. That's actually a fairly bearish move. The XAO is having trouble moving above that level around about 7,900. If it gets above 7,900, that would be a bullish move. So we hit that a few weeks ago and have
pulled back, but nowhere near as bullish, the XJO as the American markets. And the reason why it's not as bearish as the American markets is simply because we have a lot of resource-based companies, a lot of financial companies on our index, and that they're not doing as bad as the tech companies. So a lot of energy companies, BHP, Rio Tinto, Fortescue Metals, CBA, Westpac, ANZ, NAB, also Macquarie Group, released pretty good results today, I think. I wonder if the share price is down a lot. Anyway, I'll have a look at that maybe later. So the XJO is down 2.1% right now. XJO is down 2%. The XSO, which is the small caps, down 2.5%, which is not surprising that you see the small cap sector down a little bit more than the overall market. Now, let's have a look at the constituents of, well, BrainChip is up. BrainChip is up 6% today. Anyway, so let's have a look at the X. Actually, we'll go first of all the XJO. I just want to look at the overall constituents in these indices to see how they're doing. So the XJO is right now down 2.2%. Trading View, I think, is delayed 10 or 20 minutes. ComSec, which I'm right now, is not delayed at all. So right now, this very second, at 11:04 a.m. on the 6th of May, the XJO is down 2.17%. Now, I really like this ComSec site because you can look at the index makeup or the constituents and just see how companies are doing within this makeup. So this is the top 200 companies on the ASX. How are they doing? First of all, how many companies have risen today? 3. So this is overall general weakness in the market. Gold companies not doing well. Health companies not doing well. Resource companies not doing well. The only company doing well in the ASX 200 is PolyNovo. Is this PolyNovo? Well, let's have a look. PolyNovo is up 3.5% today. The next best performing company is NHF. That's up 0.2%. That's that health company, NIB Holdings. And then we also have Janus, which is up 0.08%. I think Janus is up because yesterday they were down 13%. So a little bit of a rebound because of a big down day yesterday. But otherwise, every other company is either flat, which is only 3 companies, or down big. So let's have a look at which companies are suffering the most today. 360, not surprising. Up or down 10% or just less than 10%. That company, I won't say overvalued, but there is a high valuation attached to that company. And we are seeing 360 share price really under significant pressure over the past, we'll say 6 months since November of last year. In fact, the share price has dropped from $14 to a current share price of $3.31. So this is a company that's in that tech sector. So it's not surprising we're seeing significant decreases in that company's share price. Paladin, which is uranium, NWS, which is, what's that company called? The News Corporation. They did release some results, if I remember correctly. Yeah, full financial year 2022 third quarter earnings release. So market did not like that. And really, if the market doesn't like something you release today on an overall general weakness in the market, you're going to see a share price hit a lot. And then Xero's there. So I have put Xero onto my watch list. The more that falls, the more enticing that gets. That's down 6.7%. PointsBet down 6.3%. Macquarie Bank down 6%. So the market really hasn't loved their results. REA Group released third quarter results, down 6%. The more that falls, the more enticing. I am an ex-shareholder of that company. AVZ got clearance for their mine in Democratic Republic of Congo. Amazing trading with AVZ Minerals the other day. We saw the share price drop 20%. At the start of trading, the share price was up, I think, about 20%. If you just look at the 5-day trading of this company, you can see the share price opened towards $1.20 on news that the ministerial decree received toward the mining license. So the market saw something they didn't like in it deep in the announcement, and that's why we saw or have seen a major sell-off with AVZ Minerals. I think might not be right. So a lot of other companies here: Liontown Resources, Novonix, Cochlear, which I have put onto my potential buy list as well. Looked like the share price could have been breaking out. Megaport down there below, Tyro Payments. So a lot of these companies, not surprising, they're down big because generally these companies already
have seen their share price in a downtrend. And when you see negative news in regards to overall general negative news and the share price already in a downtrend, you will see those share price drop even further. So let's have a look at the XEO, which is the 300. Or is it 300? Maybe it's 500. I forget how many companies are in this. So more companies within the makeup of this index. And at the moment, this is down 2.3%. So for some reason, BrainChip is on a tear. So as a shareholder of this company, I'm not disappointed with that. It's up 15.6%. So did they release any information? Let's have a look. No information. So maybe someone found something, a shareholder found something, shared it on Twitter, Hot Copper, something like that. Maybe that's the reason why the share price is on a bit of a tear today. Our next best performing company in the ordinaries is Polynovo. We've also seen, what's SLS? Solstice Minerals, I don't know much about this company at all. That's up 2.44%. This one is Rio something, Rhythm Biosciences, Oz Forex Group, which is in my portfolio, Base Resources in my portfolio. Aussie Broadband up 6% or 1.5%, up 6 cents today. That's after a massive drop the other day. Sezzle's up also today. So quite a few companies up today, which is not surprising. So more companies in this index than the other one. Worst performing companies is Atomos, down 43%. It was at one point down about 55%. They did release an update to their performance, their financial performance. It was not good. That company is looking even more enticing. The market cap of that company is around $70 million with the share price down 43%. Temple & Webster down 12.6%. Did they release some updates? Let's have a look. They released an update on the 4th of May. So the other day, a trading update, the market was, so this share price of Temple & Webster is really under pressure right now. You can just see that share price in a well-defined downtrend. Again, when share price is in a well-defined downtrend, you see overall general weakness in the market, those companies are going to be hit the hardest, usually. Not always, but usually. Adore Beauty down 9.5%. AIS, which is Aries Resources, down 9.1%. Paladin down 9.1%. Satire down 8. This share price of this company just keeps on dropping. Just look at how weak this chart is. You can just see how bad a day like this is for Satire. Share price of this company has dropped from $4.75 6 months ago to a current share price of 52 cents. Lots of weakness in that company. They did release another trading update, sort of, on the 28th of April. And ever since then, the share price just keeps on dropping. 10%, 2%, 4.7%, 6%, 1%, down 8.8% today. So lots of other companies down here. Lake Resources down 7.7%. Whisper down 7.5%. So a few tech companies in here as well. Let's have a look at the XSO just to see. I'm not sure about the makeup of this index, but we can just see what companies are doing good, what two companies are doing bad. BrainChip is the best performing company, but what companies are doing? Actually, ECX, which is Eclipse, they released their full-year result, not half-year results, if I remember correctly. And there wasn't much reaction from that. Was it yesterday, the 5th of May? Yeah, the 5th of May, they did release their full-year results, or financial year 22 half-year results. The market didn't react that much, only up 0.3% on the back of that yesterday, up another 0.37% today. So it seems like, based off the lack of negative in their share price today, the market has digested their half-year results and nothing really bad in it. So that's probably why Eclipse is not down big right now. Also, Costa Group is flat. So that's another company that I have in my portfolio. Really interesting trading on Costa Group, I've noticed. Really down big over 3 particular days. You can see the share price was in a bit of a rally and then down 3. So I think that's a major shareholder trying to get out potentially, driving the share price down, selling at any price, and now share price is rebounding off that a bit of a sell-off there. And really the uptrend or potential uptrend in the share price has come to a completion. And maybe I should be selling out of that company because my thesis around why I took a position in Costa Group has come to an end. So overall, the market is not really rallying. I was hoping maybe for a little bit of a rally right now, trading today. We're not seeing that rally. Sometimes what I do in these sort of days is just look at the 5-minute chart, and you can just see the share price just keeps, or the market just keeps on dropping so far today. If you look at the 1-minute chart, which I sometimes look at just for fun, yeah, the market just keeps on dropping. So still a lot of negative sentiment in the market right now, just today, very short term negative sentiment. Don't know how long this has to play out, but when I look at the American markets, I'm really bearish, particularly the Nasdaq, particularly those tech companies. I think some of those tech companies still have a lot to fall potentially just based off the bearish sentiment. So sometimes companies can go from being really overvalued to actually really undervalued because of sentiment. Sentiment can drive share prices of companies to being overvalued to being undervalued. And that's when you take positions, when sentiment drives those values of those companies to become really undervalued. So that's all I've got really for today. If you do have any questions about anything I've mentioned in this video, just leave a comment in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.